really need to start what's happened over the last 8 years or so. The large central banks of the world, and we've framed them being the G7 central banks, have accumulated over $10 trillion worth of assets, largely buying sovereign bonds in their domestic markets. And as they've bought this enormous quantity of assets, they've pushed investors out of those markets and forced them to buy assets in other markets. And as this has happened, we've seen a massive repricing of risk around the world. And we would say that asset prices through this got enormously distorted as that's happened. These central banks are still buying assets at the moment, but they are buying far less assets per month than they were, say, 2 years ago. In the first half of 2013, central banks were buying over $200 billion worth of assets per month. In the last half of 2015, that had fallen to around $50 billion. Obviously, we've got two very large buys in the market, being the ECB and the Bank of Japan, but that's now being offset by some central banks who are selling assets. The largest one would be the People's Bank of China, who are now starting to liquidate their foreign exchange reserves. And to do that, they're starting to sell assets that they've accumulated, but net we're still buying assets. But as the rate of purchasing has come down and come down quite dramatically, at the bottom of the risk curve, we're starting to see an unwind of those asset prices. Particularly, we look into emerging markets, we look in the commodity complex, we look in high yield, and now recently we're starting to see some other assets being repriced. It's not all connected to the slowdown in purchases by central banks. But we have to understand the starting point before we're starting to see these markets unwind was a mass distortion in asset prices. What do we mean by quantitative tightening? Quantitative tightening over the next 3 years will be when the accumulations stop and we actually start to get sales on a net basis by these G7 central banks. We're not there yet. But we think it's very likely that the US Federal Reserve over the next 3 years is starting to lift short-term interest rates, and it's going to be very, very gradual. But if you look a little bit longer than the next 12 months, the next stage of their monetary policy will be to start to shrink their balance sheet. And as they do, they will start to become net sellers. We've got China that is a net seller. And the big elephant in this room around quantitative tightening is actually in the next 3 years, not today, it's not going to happen today on the next 12 months, but in the next 3 years, what's the ECB going to do? They're buying 60 billion euros per month of assets at the moment. Per month. 720 billion euros a year. In the next 3 years, are they going to keep this printing program going? Or will they actually take the first step and stop buying? They won't start selling, but if they stop buying, we're going to see a massive change. And in aggregate, there's a reasonable probability that the big central banks will start selling on a monthly basis. We have not seen this for 8 years. And what are going to be the consequences for asset prices with quantitative tightening instead of quantitative easing? Whether that happens or not will actually depend what happens in global economies, of course. But we think it's at least a 50% probability that it does happen over the next 3 years. This isn't the next 12 months. But we are starting to see the consequences of the slowdown in asset accumulation by these banks. And we think it's a major contributor to some of the repricing of risk we're seeing in markets at the moment. Well, you're right. China is really in the centre of the bullseye in investor attention at the moment, and there's great uncertainty what's going to happen in China. The markets are becoming more worried about a hard landing scenario or a financial crisis developing because of the massive build-up in credit we've seen in their economy and the massive property boom that has been experienced in the last 5 years or so in China. To put it in context, in the 5 years from 2010 to 2014, China consumed more cement in that 5-year period than was consumed in the United States in the entire 20th century. So the scale of what happened in China has been breathtaking. Are we going to have a hard landing scenario in China, a financial crisis? We actually think those fears are well overblown. At the end of the day, we're actually not that concerned. It could happen, but we think the probability of that is low. What's actually going on in China? Yes, we have a slowdown in investment activity. There's been quite a dramatic slowdown in investment activity in China. And if you look outside in a broad range of statistics, cement production is now negative. Property construction has fallen very dramatically. Steel production is negative. Electricity consumption is running at zero growth year on year. So there's been a massive slowdown in fixed asset investment in that economy. Exports aren't down, but they're much weaker than they were. That's probably a global economy issue. But on the other side of the equation in China, the services sector is growing strongly. Wages are growing at about 8% year on year, and retail consumption is growing at over 10% a year at the moment. So if you look at the consumer part of the economy, which is growing, it's growing strongly. If you look at the services side of the economy, it's growing strongly. And we would argue the dramatic slowdown in property development is actually healthy if you're going to avoid a financial crisis in China. Another element that's having a drag on the Chinese economy is a massive capital outflow that we're seeing in China. Domestic residents are fleeing the country and they're taking money out. And of course, as money goes out, that's also a drag on the economy. So there are genuine issues, and China is slowing down. And we do not see a rebound in fixed asset investment. We think that's going to remain low for a considerable period of time. But the consumption side and the services side of the economy, it's looking pretty healthy. And we believe that the government, with correct policy, will avoid a hard landing scenario. We're not predicting a bounce back in overall economic activity. We think it will continue to slow, but the fears in the market that you're going to get a collapse in China, we think are overdone. We're not subscribers to the sort of 50% dramatic fall in the renminbi. There are pressures on the renminbi at the moment because we have domestic people in China trying to get their money out, and we're seeing large capital outflows. So of course, if people are taking their money out, they are selling renminbi to buy foreign currency, and that is putting pressure on the renminbi. But as that money's leaving, the People's Bank of China has a very strong incentive from a policy point of view to effectively dip into their foreign exchange reserves and bring some of those foreign exchange reserves home, effectively to offset the contraction in the money supply that's happening as money is leaving the country. And given they've got $3.5 trillion worth of foreign exchange reserves, we think they have very, very substantial firepower to effectively offset, from a policy point of view, the capital leaving the country. And therefore, we think a large devaluation is unlikely because of the strong monetary incentive the People's Bank of China has to effectively buy renminbi to bring foreign exchange reserves home at the moment. The question is how is this money leaving the country? They have a $50,000 limit per individual per year in people being able to take capital out, but it looks like a very leaky sieve. And of course, there's a huge black market where people effectively sell their entitlement and people buy the entitlement. And when you've got over 1 billion people, there's obviously a lot of entitlements there. And we would expect the Chinese authorities are going to clamp down on effectively the rampant abuse of their $50,000 limit per annum. And as that happens, I think he's going to take some pressure off the renminbi. Do we see mild devaluations of the renminbi happening? Yes, we do, but a massive devaluation, I think they're underestimating the authorities in China, and particularly incentive from a monetary point of view to stimulate the economy by bringing foreign exchange reserves home. We are quite relaxed at the moment with the sell-off in markets. There are certainly things we're looking at that fundamentally are becoming more attractive. As the price falls, and we're not that worried about a hard landing, and the US is still looking quite robust, from an absolute level of earnings power of these companies, it's still looking pretty robust in many of the companies we look at, and as prices become cheaper, they're becoming more attractive to look at. But we're in a headwind of quantitative tightening in the world, where rates will go up and buying activity by central banks over 3 years is likely to change. So there are still parts of the equity complex, particularly that are very defensive equities, that still look pretty fully valued to us. So we're being patient. I'm relaxed about that, and it's unwinding some of the excesses that were in the system. But certainly on a selective basis, there are some equities that are looking pretty attractive in this environment. I don't want to flag what we're doing intra-quarter, but I'd say there are opportunities that are coming up that are more attractive than they've been in some time.